All right. Well, thanks for joining today. This is a joint webinar between Halo and Riskalyze. My name's Dave Townsend. I got Chloe Gallman here from Halo as well. And Chloe's one of our regional vice presidents, and she's an expert in all things structured products. We'll get to her a little bit at the end, but we also have James Wilson here, who's a success coach on the from Riskalyze. We love doing these webinars with Riskalyze mainly because Halo is very risk management is near and dear to what we do, and obviously Riskalyze, it's the core of what they do. So it always makes for a good mashup here. So we thank James for jumping on today, and he's got a little bit introduce us to Riskalyze a little bit better, and then we'll jump into what Halo can help you with. All right, James, take it away.
Sounds good. Absolutely. Well, thank you, David. And also thank you everybody here joining us today. Really do appreciate your time. As David mentioned, my name is James Wilson. I am from Riskalyze on our success coaching team. And today I'm just kind of going to give an overview of what we do here at Riskalyze, as well as kind of how we play hand in hand with Halo. And so one moment, I'm going to go ahead and just get a presentation launched here. Let me just share my screen. Awesome. So, of course, we are Riskalyze. As the name sort of suggests, of course, we work very closely in the risk management space, particularly with helping clients come to an understanding of their own personal risk tolerance and how that plays in with their portfolio. And so the way we do that is we have something called the risk number. And so for those who might not be aware, haven't heard of us, what that risk number is it's a more objective scale of a person or particular investment's risk level on a sort of more, again, objective scale than say, I'm a moderate investor, I'm a conservative investor. And we do that on a scale of 1 to 99, 1 being the most conservative, 99 being the most aggressive, of course. And so what we're seeing here is sort of what we would call our core 4 of Riskalyze. That is to say, the risk level of the particular client. In this case, that is to say how much risk they want, their level of risk in their portfolio, that is to say how much risk they're currently taking on. And so from there, we'll discuss whether there is some alignment issues, whether that be too high or too low. Point being, we want to make sure that what we're investing them in ultimately matches their own risk tolerance. And so to that end, that's where we end up building them a proposed portfolio, which is to say how much risk they should have, and then also talk a bit through with them on our retirement map on how that sort of investment will allow them to reach their long-term goals as sort of the 4th piece of that core 4. And so then, as you can see, how much risk they want, how much risk they have, how much risk they need, and then how much risk they should have. And one of the great things about Riskalyze in particular, and how we specifically grade risk, is that we're actually based off of a Nobel Prize winning framework called prospect theory that largely just says that we as humans are approximately twice as likely to be concerned with potential losses as opposed we are to be elated or in anticipation of potential gains. And so to that end, one of the things that we do when we do grade risk is we go straight down to the investment level. We do not just necessarily say all large cap stock functions are the same. And with regards to our guests, our hosts here that are having me guest here, my bad, Halo here today, we actually do the same thing with their products. We can actually grade those on a risk number spectrum, again, from that 1 to 99, so that you can show your clients how those particular products actually impact their portfolio beyond just sort of what you might normally expect, like a stock or a bond or an ETF, that kind of thing. Here's an example of what that looks like and what a portfolio kind of looks like inside of Riskalyze. Again, we are grading all of these investments down to their actual data, not just at sort of the asset class level. You're noticing here that we're not necessarily treating all of these individual stocks the same. And so also to that end, we have a bunch of tools that help with the client understanding that analysis and why you're investing them the way they are. Again, helping prove best interests, as well as kind of arming the client with the knowledge that they need to understand their investments. Say they want to understand what happens in a particular market scenario, like what if 2008 were to happen again, or what if 2013 were to happen again. We have stress tests that allow you to show them with their portfolio, hey, here's how you would do given those circumstances repeating themselves. And once again, you can also have those Halo structured products in there and show them how those might actually impact things as well. We also have historical comparisons here showing folks how their portfolio might perform compared to a whole bunch of different other proposals or models or benchmarks otherwise that you might want to show, as well as sort of that prediction kind of piece there. And so kind of just going back to what we had then real quick at the end, again, we are identifying the amount of risk a particular person wants via our questionnaire, the amount of risk that a person has in their portfolio, in which we can grade investments down to the actual individual security level, how much risk they should have, which is to say aligning their portfolio's risk with their risk number, and then using that retirement map to show them how that's going to help them reach their long-term goals. Speaking of that retirement map, here's just kind of a bit of a show off of what that looks like too. You know, we can even on this retirement map, add in specific events that are lifetime pieces that change over time. You know, say they send their kids to college, say they're looking to take out money for putting a down payment on a house. You can model those and show them how with their portfolio and assumptions that you put in, such as how much money they want to take out when they reach retirement, how much money they're saving right now, you can adjust the inflation rate, etc., what their sort of overall likelihood of reaching their goals, that is to say, reaching the sort of expected lifespan with their money left over. And so here's kind of an example of how that sort of looks. We can even swap portfolios around, show them a specific risk target to a particular risk number. If, say, for instance, we wanted to show them how their portfolio might compare with others as well. We also have, you know, going back specifically to what I was mentioning with Halo earlier, we also have all of that information on their structured products that end up in here through our integration with them. And not only that, not only can you get all of that information within Riskalyze and sort of show, you know, your clients or prospects how notes might help their portfolio, we even have an integration with them that allows you to actually click on into Halo. You're sort of noticing that button there in the upper image right next to the note that'll allow you to actually go to this dashboard. In addition, you know, we also have comprehensive statistical analysis for investments in here. Say you want to show them how a particular note compares to what is in their portfolio right now, or a particular benchmark, like you're seeing here, a 50-50 blend. We also have information regarding diversification. You know, how well diversified is this portfolio? You can show them how maybe perhaps their current portfolio isn't so well diversified, or you can show them how yours might be well diversified. And once again, all of this information is available with the notes through Halo and that integration as well. Asset classification, straight down to the sector level, not just sort of on the overarching mutual fund ETF level, so that you can see, hey, here's where you're specifically focused to. And once again, you can get all that information with regards to those notes. Lastly, and this is actually a super cool feature that we just launched recently, called Discovery, which allows you to screen our database for specific investments that meet certain parameters that you're looking for, including whether those things be like the risk number, their efficiency with the GPA, a particular kind of security, those kinds of metrics, to ultimately isolate the kinds of investments you're looking for and test them in the portfolio. And so that actually is going to do that for the slide portion. Again, though, thank you so much for having me. If you do have any other questions, again, there is that Q&A box. And if we have any Riskalyze specific stuff come up at the end, obviously, David, I'm happy to take those too. But thank you again so much.
Yeah, of course. James, you're being quite modest for Riskalyze's power. Traditionally, modeling options and financial products with asymmetric return distributions have been a problem for most risk management systems. So it's a wonderful partnership and integration that we enjoy with you to really bring this to the market, which is cutting edge, particularly at the retail level. Now, institutional investors and hedge funds and other sophisticated investors have had some of these tools for quite some time, but for the average everyday Joe, literally now you can model annuities and structured products and options and so forth, which was just unthinkable certainly 10 years ago, maybe even 5. So
yep.
Your guys' advancements are great, and we always look forward to hooking up with you again at the investing fair, the summit, the Fearless Summit out in Salt Lake City this year, right?
Indeed, that will be happening later next month, towards the end of October. Tickets still being sold too, so if anyone wants to still join us, feel free to go to our site, riskalyze.com. There'll be a big banner there talking about it. It'll be really hard to miss it. But yeah, it's going to be a great time. Best practices, breakouts, all the fun stuff. And
even better, sign up. We'll meet you out there. We'll buy you dinner. We always look forward to hooking up with advisors when we're out there. So get in touch with us after this. We'll obviously send some follow-up details. Maybe even somebody we could drop it in the chat to get in touch with Halo, so we can meet one-to-one with you. And again, Chloe is at the ready. If you've got any questions, we'll bring her on for the Q&A portion. So I want to introduce you to structured products through the Halo platform. So I'm a no-nonsense kind of guy, and I like to cut to the chase and say, like, how do I benefit? What does this do for me? And that's what I really want to get across here today. So briefly, again, we're Halo. We're a platform for structured products, annuities, and buffered ETFs. Perhaps equally important, we're a team of financial professionals that have I know it's somewhat cliche, built by advisors for advisors, but we really do embody that and want to help the retail sector as much as humanly possible to across all, not just the technology, but the arming them with the knowledge and skills and confidence to use these things. And about me, I'm Dave Townsend. I'm our head of product marketing and thought leadership here. And so let me step you through this. I'm going to cut right to the chase and show you how managing with structured products, you can help manage market uncertainty, investor behavior, and your advisory practice. How so? Well, more importantly, it's about improving outcomes in the investment experience. Everybody talks a big game when it comes to financial products. I'm sure there's wonderful ETFs out there that can help you enhance the client experience. We would contend that a few of them out there exist, quite like the structured note, that could satisfy a number of things. Obviously, this is about helping you grow your book and really about saving you some time. So this begins with the idea of the bell curve. Now, relax. I know it's been a long day. Markets were down again, maybe even a long week. It's only Tuesday, and the Fed has some more announcements tomorrow. But the important thing here is about the asymmetry with which most conventional financial products are subject to. And I'm going to give you a little foreshadowing. The whole point to a structured product is really to dial in a risk return profile that is just kind of hard, if not impossible, to do in conventional methods. So relax. There is no statistical analysis here, and this is going to be entirely about pictures. I know they're a little bit small. We can get you the follow-up afterwards. And so ultimately what we're trying to do here is that, say, as you deviate from expectations, you can see here in these 3 different slots here, 1, 2, 3, and 4, Again, I know it's a little bit small, but as you move away from client expectations, whatever that is, that could be a benchmark return, it could be an absolute return, or it could be relative to what their neighbors are doing. Whatever it is, and chances are there's probably some bizarre benchmark that you're being held to, as the expectations or the experience and outcomes deviate from these expectations, first you start getting some annoying phone calls, then maybe some assets get pulled, maybe a little bit more, and then out in the further extreme, the client pulls all their assets. We contend that this can be managed better outcomes by moving more towards using structured notes. You can control for in the first 3 slots, 1, 2, and 3, those annoying phone calls, and perhaps maybe even save some assets being pulled. Now, to be clear, most structured notes, most structured products are not tail risk, black swan event type hedges. They're for your standard downside deviation. As you eliminate those, which I'll build to in a second, which traditionally we've done with diversification, that's getting harder and harder. We say that with a structured note, it is a better approach to keep the client in their seats for those smaller deviations. I'm sure you've had the experience where the client says, "Oh, I'm invested for 30 years. I know the market goes up and down. Six weeks into a relationship, there's a dip, and before you know it, they want to pull all their assets." What we're saying is, with a structured note, you can take advantage of the benefits of asymmetry. So between growth or income, there's a balance here that is hard to do with conventional allocation strategies, that you can dial in a risk return profile that is simply hard to achieve otherwise. It is far more efficient. For as minimum of $1,000 now, you can buy notes. Unthinkable years ago, where it was $1 million probably to get started for a high net worth individual. Today, with the benefit of platforms such as Halo, and we'll talk a little bit about the platform in a little bit here, you could take advantage of this asymmetric relationship far more efficient than what has traditionally been available. And so, without getting into any more statistical, what we are saying is that you could take advantage of skew, kurtosis, otherwise this divergence from the normal curve, meaning you can dial in or effectively concentrate a return distribution, hence the name defined outcome. This is why products such as a buffered ETF or a structured note is called a defined outcome, is that you concentrate the potential outcomes or return distribution to something far more finely tailored to the investor. One way or another, even if you're in, say, a classic strategy 60-40, and I won't do any picking on 60-40, that's been beat to death. Even if unconsciously you are, by whatever your allocation strategy is, you're making even if it's unconsciously, you're making a decision on what the return distribution might look like. What we're saying is that through the structured note, you could help to refine that even further. And so this brings us to this classic chart that you've seen. Again, I know it's kind of small there. I could probably click on this one here to that this is the loss is key, that it takes so much more to recover from loss. And so what ends up happening is that investors, perhaps your clients, are inadvertently taking more risk than what they should, what we argue, using conventional methods. And when these losses occur, it just takes that much more return to get right back to even. And so what we're looking to do is provide something like this. This is just a generic sort of payoff here, where this is an asymmetric relationship, where we're sort of capping losses on the downside with some level of potential gain on the upside. And so this is the whole essence of structured products. Zooming out a little bit more, so the case for structured products, undoubtedly, you've probably heard about advisors getting, you're probably getting more and more calls about alternative investments and how they can help diversify a portfolio and so forth. What is the challenge, though, is that under traditional methods, correlation is hard to achieve. for much of history, it was actually stocks and bonds have had positive correlation. So this has been beat to death, and I'm happy to go down the rabbit hole with you offline about how correlation is part of the bigger problem to the management today. But I won't go down that rabbit hole. Perhaps a bigger picture is when we start looking at the risk and return, it's really about the efficient frontier flattening, meaning per unit of risk, we have to take ever more risk to hit the same level of return. And here's a particular efficient frontier by DWS, which is Deutsche Bank's asset management group. And so the top line, the green one, which is a steeper line, and again, we're not going to get into the wonky parts of efficient frontier and modern portfolio theory and all of that. Essentially, what happens is when the frontier starts to flatten, risk and return, you just don't get as much risk. What has effectively happened after decades of zero interest rate policy and quantitative easing, you name it, we've thrown the kitchen sink at producing growth, and so a great deal of growth has been pulled forward. And so said another way, of course, AQR in February of this year, which is just one of many, have said, hey, it's 60-40 just isn't going to produce. It doesn't have enough octane in the tank to get you where you need to go using conventional methods. Callan came out with a chart. This is always a classic where they've shown it takes 5 times as much risk today as 30 years ago to achieve a 7% return. Now, you can see that the complexity in portfolios is increased as well. Long story short, no matter how you cut it, just conventional methods are just very hard to achieve to satisfy the return objectives and expectations that people have come to enjoy. So what's the solution? Well, crypto, of course. Oh, actually, this was a joke. I threw this one in here. You could see here, since we're talking about return distributions, apparently crypto, we did not put this together, and I was only threw this in here as sort of tongue-in-cheek. Of course, they did, whoever put this together did misspell outperformance, which is somewhat ironic that apparently they think that crypto, it goes all the way to the moon. But what's more important is the effect that these kind of things have on people, where just recently, apparently retail investors perceive stocks and bonds to be more arcane than crypto. And so this is my acknowledgement to, look, I understand the world that we're dealing with, and especially advisors such as yourself out on the front lines every day. It's hard. I mean, it's hard to get people to change behavior. And so Halo understands this, and we want you to know that we know it's not easy to get people to make smart financial decisions, but we're here to help. So notes have obviously been gained in popularity more recently, and we'll break down why that is here in a little bit. But I do want to clear up a little bit of misconceptions. There's a little bit of misconception around what a structured note is. We want to be clear, this is not sort of the high finance stuff that say the CDOs, CLOs, and the structured finance from the great financial crisis, of course, which was linked to the housing bust and so forth. This is nothing. This is not that sort of high finance where they shall remain nameless, but like one of the big investment banks helped Greece get into some the country of Greece get into some bad CDS and CDO and all these other credit derivatives. This is not the stuff that we're talking about. The significance here is that sometimes these things we get lumped in, the structured note space gets lumped in as like all of structured finance. Like any financial product, there have been good and bad, right? And so I'll leave it at that. The other part too is that one of the misconceptions that, and this happens a lot with like in the financial press, is that the structured products are treated, or structured notes more specifically, are treated as something of a relative analysis, where it's a replacement for, say, stocks or bonds or so forth. Really, structured products are is a vehicle to tap into these assets, and not necessarily a tool to, under a relative analysis piece, to say, oh, hey, stocks are no good now, so structured notes. No, it doesn't. Like, when stocks are doing good or when stocks are doing bad or whatever that frame is there for you, notes might be appropriate regardless of that. So I just want to clear up a little bit of misconceptions of what people think notes do. So let's dive into that. This is not a structured note, but it is a helpful way to think about how we could start building towards how notes fit into a portfolio. So obviously this is probably someone's, I think this is probably Goldman Sachs version. You've probably seen model portfolios such as this, that across this efficient frontier, these different portfolios have different allocations to stocks and bonds. This is useful when we start building towards where do notes fit into the equation. And here we see that in the lower left-hand corner, you could have probably principal protected notes moving up into income notes near the middle, which are akin to, say, fixed income, and then growth notes, which are more aligned with equities. More specifically, notes are made up of the following components, and I'll zoom back out here because they are this Swiss Army knife of investment vehicles. The sky is the limit to refine these along 4 key parameters: maturity, underlying, the payoff, and protection. And experts like Chloe can help folks dial these in. And so it's not uncommon for advisors to come to us, look, because notes are very customizable. Sometimes it's like, hey, here's the basic parameters. How can you help us get started? And so it isn't that, on the Halo platform, we don't just turn you loose to say, hey, here's a bunch of parameters, start pricing things up and see what you can come up with. You are welcome to do that. And some people do enjoy that, but Halo is here to help. And principally, this is along 2 fronts: growth notes and income notes. So obviously the growth notes are more analogous to equities, and income notes, which target a specific yield, are more often considered something of a fixed income product. Now, other names that you may have heard of this is, say, for growth, it's common participation note, and for income, it's usually like yield enhancement or enhanced yield component. So one more time, hey, why do I need this? Well, going back to the beginning, if the efficient frontier is indeed flattening, this is effectively driving down, regardless of your allocation. Even if you're a cowboy and you're out on the far extreme, and in this instance here, you're in 90% equities. No matter how you cut it, if the efficient frontier is starting to flatten, you're not going to achieve the same level of return, which again leaves your clients calling and asking. They see these things in the news. What are we going to do? What's there left to do? And it isn't a matter of just tinkering with, oh, we'll do 70, 30, 40, 50, so forth. It's just harder and harder to achieve the same level of returns using the same playbook, which brings us to why this is important. Classically, institutional investors have employed a asset liability management perspective, and for the most part, conventional retail investors have used an asset only. As we move more towards a goal-based strategy in financial planning, and perhaps some of your clients are already, bucket these things in terms of goals. Notes and structured products really kind of start to help us narrow and pinpoint to specific unique needs, such as institutional investors have been doing for quite some time. Now, if you still like to use classic asset allocation, and again, I know it's kind of small here, but on the left-hand side, here's a picture. This is how I think of it, is that classic or conventional asset allocation, where you've got all these different ingredients, stocks, bonds, and all kinds of different assets, and you can assemble these things yourself. The problem is that it gets quite difficult to do this, and there are better ways that are somewhat pre-made or pre-packaged, such as what a note can do, and this is more of a modern twist. And I believe on the right-hand side here, and again, I know it's kind of small, is like Tavola, which I believe is prepackaged meals. I don't get it, so I can't have no warranty if how well their product is. But essentially, prepackaged meals, you pop it in the microwave, there's an app, and you're off to the races. And so what notes can do here, and this is the essence of what notes do, is about creating structural alpha here. That we're going to move the efficient frontier without an asset allocation. It isn't about picking better stocks or better bonds. That stuff is fun, and if you enjoy doing that stuff, that's fine. but there's an easier way or a more efficient way to start moving up the efficient frontier, which again pushes this up, right? Props this up, this relationship, or classically, you've probably seen it something like this, where as we shift the classic, and so the gray is sort of the 60-40 stock bond, and as you introduce uncorrelated assets such as alternatives, it pushes the efficient frontier out to the left. And that's what we are doing with structured notes, is that we're bending that risk return relationship in ways that are just it is inefficient to do with conventional stocks and bond allocations. Just to dive in a little bit more about Halo, again, we're a platform for structured notes, annuities, and buffered ETFs, and a team of professionals that go along with it on platform. And I'll let Chloe, if you have any questions about some of these attributes, there's pre-trade tools such as filtering and risk management tools to say, how does a portfolio look with a note, or what is the relationship? So a whole series of different pre-trade tools. Trade execution, Halo has a dedicated trade desk, which is a huge piece to this relationship, that it just is cost ineffective for most people to go out and build a desk internally. So in a sense, you're outsourcing that component to Halo. And then of course, post-trade, which is the life cycle management, which has classically been done. For those of you that may use notes or know folks who have used notes, it has classically been done with like Excel spreadsheets and something very manually and just very time consuming. Today, it's all electronic. And so the Halo platform can send you reminders of maturing notes, coupon payments, and all kinds of other electronic automated messages. And so this gets at the last part that I said, is about delivering on advisor alpha. Obviously, this is quite small, but in one shape or another, you're probably familiar. There's a lot of people out there, and they call it different. Morningstar calls it something different. Gamma, actually. Vanguard calls it something else. But approximately, financial advisors are thought to provide about 3% alpha. I say that what the significance to the alpha bit is that not the alpha part of things, is that nobody ever really talks about sustainable advisor alpha and what it takes to effectively get there. Structured notes can help with those lower level rebalancing, portfolio allocation, and the stuff that just doesn't really add a great deal of value to the relationship. When we drill into something like this, it's the relationship management part of things where the specialization comes in, and that's what financial advisors are so wonderful at doing, is that in portfolio allocation and building portfolios and so forth. But the problem is just the reward to it isn't there like it used to be. And so much today, part of that can be outsourced or partnering with folks such as Halo to help provide some of those more lower value items. And so obviously it's all about time management, right? Where as this is historically, a practice management was a smaller part of what advisors did. You've seen some variation of this invariably one way or another. And so what I'm saying here is that through Halo, we can help you save some time by giving you the tools, as well as the access to the team of financial professionals to help to ease some of that burden to getting started. So we thank you for your time today. I want to open it up to questions. So let's get Chloe, if you want to pop back on, and if you got any questions, you guys could pop them into the Q&A piece, and we'll let them gather a few questions, and we'll go from there.
Thank you, David. We have 3 so far, so I will go ahead and answer these for everybody on the call, and then feel free, if any other questions come to mind, feel free to trickle them in the Q&A. The first one we got was, this is actually a question we get frequently. What's the catch, or what am I missing? David alluded to this at the beginning of the call. Structured notes have kind of had a negative connotation historically, going through the 2008 crisis, whatnot. Really, they were just very clunky vehicles. There was high fees. There was lack of transparency. So David mentioned this too. They were hard to track and manage. Keeping track of your coupon payments when these notes matured, et cetera, was a very manual process. And yes, there's just high fees. There wasn't a lot of liquidity in these products either. Halo has solved a lot of those issues with our platform and our connection to all of the issuing banks. So that's kind of one of the first, barriers we get through talking with folks on structured notes. The other thing to keep in mind, I guess what the catch is with a structured note, these are products that are issued by banks, JP Morgan, Morgan Stanley, Citibank, what have you. When you buy a structured note, it's similar to the concept of just buying a bond of the issuing bank. So you are adding credit risk. As long as you are comfortable with the credit risk of the issuing bank, it should not be really an issue, but we certainly encourage everybody to do their due diligence and make sure they're comfortable with that credit risk.
Hey, Chloe, while you think about, let me add to that there while you queue up
Sure.
the second question, is that one of the misconceptions, I know this is maybe a question we'll get to, is that people think that banks like profit off of notes, and when investors don't do it's not a zero-sum game. The banks are really, you're sort of like going to the banks, the issuers of structured notes. It is a funding cost arbitrage component for them. This is purely about funding cost. It is a funding component for the issuing bank. They do not profit as like when investors lose, or they don't lose when investors do well, and so forth. And so there's one of those misconceptions that we often see.
Yeah, they're simply kind of they're making the trade, they're packaging it up, and then they're hedging it immediately. And then, like David said, it's a very efficient form of funding for banks. But yes, they are not at all taking the opposite side of these trades. The second question we got was, is there a certain type or age of clients that structured notes are used for primarily? This is a good question. In a sense, there's certain types of structured notes, the two most common being growth notes and income notes. And as clients get older, we generally see more folks trickle into income structures. You can, of course, play around with any different type of structure, an underlying and protection level, but and do some type of like fixed coupon return for folks that are older or near retirement. But for younger folks, what's interesting is if you do a growth note, these types of structures with maybe longer time horizons, you can actually have enhanced upside participation. So maybe it's a note tied to S&P, a 5-year note, and maybe your downside protection is 20%, and your upside is something like 115%. That's something common that we see. So play around with different terms and see what might be appropriate for certain ages of clients. But there's buckets for these structures that can be a fit for all ages of investors. The last question I have that was sent in is what is the most common terms for a structured note? Another great question. The most common type of structured note we see is, and remember the 4 components that David showed prior, you have your term, the length of the note, the maturity or the term, the underlying S&P, any index, Apple, Google, what have you, the protection level on the downside, and then on the upside is going to be whatever your upside is. Is it a capped return? Is it a yield, etc.? So the most common on the income note side is for the most part, it's an index note. So think S&P, Russell, Dow Jones. It has a 30% downside protection level, which means if the index falls up to 30%, you're fine. Your client's covered for those losses. And then on the upside, it would have some type of yield. So maybe like 8 or 9% on the upside. Growth note, similar concept. It's usually about a 30% protection level. And I would say the majority of notes are either a 2-year or 3-year term. You can go as short as about 12 months, and you can go as long as 60 months is rather common. And then, yeah, on the growth note side, same scenario, you would just have an upside participation of 120 or 130% versus an annualized yield. David, do you have anything else to add to those questions?
No, it looks like that's it. So we'll leave it there. We respect everybody's time. We damn near hit the 40-minute mark. We promised. We'll follow up with some follow-up materials, a replay of the recording. And of course, if you want to get in touch with us, if you're heading out to Riskalyze's Fearless Investing Summit next month, get in touch with us and we'll buy you dinner or a drink or coffee or whatever floats your boat. So Chloe, thank you for joining today. And James, thanks as well.